At some point or another, almost every entrepreneur needs to raise money. This can either be the worst experience of your life or the best. It really depends on how prepared you are. Before we get too deep into this topic, let's have a little fun. Let's take a look at someone who isn't adequately prepared. Got another one for you. Over Brimley pants?
No.
Soup.
No.
The color purple. We sell it. Not the movie, just the actual color.
No.
Okay, so that's obviously not what you do. But what do you do? Well, when it comes to financing, there are two types of funding: debt and equity. Debt financing is a loan. You must pay it back with interest over a certain period of time. With equity funding, you raise money by selling portions of your ownership in your company. Today, we're going to be talking about equity funding, in particular two types: funding from angels and funding from venture capitalists. Most angel investors are successful business leaders or professionals who make significant investments in other companies, usually early-stage startups. They typically invest in businesses within their particular area of expertise. They're likely to invest in business ventures in their state or region of the country, and, in many cases, they focus on specific areas. Generally, they don't want to be the only source of funding, and they want to know where future investment capital is likely to come from. Where can you find angel investors? There are numerous websites that list angel investors, such as Band of Angels and U.S. Angel Investors. Okay, so you found an angel, and now it's time to meet. How do you prepare? Well, a meeting with an angel investor should take place in person. You should be ready with written material, business plans, projection, etc., and be prepared to answer tough questions. Angel investors want to see that you have done your homework and researched the industry thoroughly, stand firmly behind your business plan and goals, have thought through all aspects of the business from a practical aspect, have an experienced management team. Let's turn to the other type of equity funding, venture capital. Venture capital is a widely used term that doesn't have an exact meaning, but it typically refers to investment funds or partnerships that focus on up-and-coming businesses and promising startups. Let's watch a conversation between Betsy Flanagan of Startup Studio and David Hornik of August Capital as they talk about the right way to raise money from a venture capitalist.
People, people, people. It's all about the people. So I'm sure there are plenty of entrepreneurs who would really not get along with me, and those people should not take my money. And, that's just because when you have an investor and they put money in your company, they're going to be involved in your company for as long as there's a company, essentially. Certainly that's our model. Our model is I invest in a company, I invest early most often, I almost always sit on the board of directors, and I try and be as helpful as possible, and I'm certainly involved. And so if you take money from someone who you don't ultimately respect or like or trust or generally think is the right person, it's a little bit like marrying someone you don't trust and respect and like and think is the right person. Eventually, that probably won't work out that well. I don't think any entrepreneur should ever take money from an investor without having spent time talking with other people who have taken money from that investor. I just can't imagine. When I'm looking at a company and I'm talking with an entrepreneur, I then call, their kindergarten teacher. I call the people for whom they've worked and people who've worked for them, and I do all these reference calls. Why, as an entrepreneur, wouldn't you do the same on your investor? I think, and my experience is there's an incredible correlation between the people who I think are really smart, really good entrepreneurs, and the ones who have called without asking me.
You should also be aware that most venture capitalists are only interested in companies that can grow to be large. So, if you're a small grocery store, a neighborhood sushi bar, or a corner lemonade stand, don't bother seeking venture capital, unless you plan on building a lemonade or sushi empire. Thanks for watching. I'm Joel Devev. We hope you learned something.